There is a silent mathematical catastrophe unfolding right now inside the regional banking system, and the mainstream financial media is absolutely terrified to talk about it. They do not want to trigger a panic, but the data is completely undeniable. Right now, a $1.5 trillion wall of toxic debt is crashing down on the financial system, and your local bank is the one holding the bag. Hello everyone, I am John Agg, and welcome back to the Wealth Reactor. Today we are exposing the ultimate financial time bomb of the decade. We are going to deconstruct the commercial real estate crisis, explain exactly why your regional bank might be quietly insolvent, and show you how to pull your wealth out of the blast radius before the Federal Deposit Insurance Corporation locks the doors on a Friday night. To understand the sheer magnitude of this crisis, we have to look at the exact mechanics of commercial real estate debt. Unlike a traditional 30-year home mortgage, commercial loans for massive office buildings, shopping malls, and industrial complexes are usually structured as short-term, interest-only loans. They typically last for 5 to 10 years. At the end of that term, the massive principal balance comes due all at once. The property owner does not pay it off in cash, they simply refinance the debt into a brand new loan. This system works perfectly as long as interest rates stay exactly the same. But the macroeconomic environment has violently changed. During the era of free money in the late 2010s and early 2020s, commercial landlords took out trillions of dollars in debt at ultra-low interest rates, hovering around 3 to 4%. Now, in the year 2026, that massive mountain of debt has reached its expiration date. This is what Wall Street calls the maturity wall. Between last year and the end of 2026, over $1.5 trillion in commercial real estate loans are coming due. Here is the terrifying mathematical problem. These landlords now have to refinance their massive loans in an environment where interest rates are significantly higher. The cost to service that debt has essentially doubled. But it gets much worse because the actual asset backing the loan has completely collapsed in value. We are currently living through what economists call the urban doom loop. Following the massive global shift to remote work, downtown office buildings in major metropolitan areas like San Francisco, Chicago, and New York have essentially become ghost towns. Vacancy rates have skyrocketed past 20%. Without tenant rent flowing in, the building generates zero cash flow. Because commercial buildings are valued entirely based on the income they generate, the mathematical value of these skyscrapers has plummeted by 40 to 50%. Imagine you are a commercial landlord. 5 years ago, you bought a massive office tower for $100 million, and you took out a $60 million loan from a bank to pay for it. Today, that exact same building is only worth $50 million on the open market, but you still owe the bank $60 million. Your equity is completely wiped out. You are deeply underwater. When the loan matures, no rational lender will let you refinance. So, what do? You simply hand the keys back to the bank and walk away. You default. This is where the crisis transfers from the real estate sector directly into your checking account. The mainstream media wants you to believe that if commercial real estate crashes, only the wealthy Wall Street billionaires will lose money. That is a complete and total lie. The massive Wall Street mega banks, like JP Morgan and Bank of America, saw this crash coming years ago and aggressively dumped their commercial real estate exposure. So who is holding the toxic debt? The regional banks. Small and medium-sized local banks account for roughly 70 to 80% of all commercial real estate lending in the United States. Your local community bank, the exact same institution where your business payroll and family savings are currently sitting, is holding a massive portfolio of underwater, non-performing office loans. For the last 2 years, these regional banks have been playing a dangerous game called extend and pretend. When a commercial loan came due, Instead of forcing the landlord to default and realizing the massive loss on their own balance sheet, the banks simply extended the deadline. They gave the landlords another 12 to 24 months, desperately praying that the Federal Reserve would drop interest rates back to zero and magically fix the problem. But Chairman Kevin Warsh and the Federal Reserve did not drop rates back to zero. Inflation remains incredibly sticky, and the era of free money is officially dead. The extend and pretend game is mathematically over. The banks are now being forced to foreclose on empty office buildings, take massive losses, and wipe out their own capital reserves. This brings us to the ultimate threat to your personal wealth, the weekend bank seizure and the legal reality of the bail-in. When a regional bank takes too many losses on commercial real estate and becomes insolvent, the government does not announce it on a Tuesday morning. That would cause an immediate, catastrophic bank run. Instead, they wait until you go to sleep on a Friday night. The regulators quietly step in, seize the bank, lock the digital accounts, and freeze the automated teller machines over the weekend while they desperately try to sell the toxic assets to a larger bank. You must understand your legal standing in this scenario. When you deposit your hard-earned digital fiat currency into a bank, it is no longer your property. Legally, you become an unsecured creditor to that institution. You have simply given them an unsecured loan, and they have given you an IOU on a digital screen. If that bank goes under because of bad commercial real estate bets, your money is completely trapped in the bankruptcy process. The government will tell you not to panic because the Federal Deposit Insurance Corporation will protect your deposits. But the insurance fund is completely undercapitalized. They do not have the trillions of dollars in cash required to cover a systemic collapse of the regional banking sector. If multiple regional banks fail simultaneously due to this $1.5 trillion maturity wall, the government will be forced to either print massive amounts of new currency to bail them out, which will trigger hyperinflation, or they will execute a legal bail-in, where they simply freeze a portion of your digital deposits to recapitalize the failing bank. So, how do we survive this? How do we navigate a banking system that is heavily leveraged against empty office buildings and toxic debt? At the Wealth Reactor, we operate by a simple rule: become your own central bank. You must remove your excess wealth from the digital fractional reserve banking matrix. You must hold hard, tangible assets that carry absolutely zero counterparty risk. This is exactly why the smartest institutional money is aggressively stacking physical silver and pure gold bullion. When you hold a physical silver coin in your own hand, it is completely immune to the commercial real estate crash. It does not care if an office building in San Francisco goes completely bankrupt. It does not care if your local regional bank is seized on a Friday night. Physical precious metals cannot go bankrupt, they cannot be frozen by an algorithm, and they cannot be printed into oblivion to bail out a reckless banking sector. They are the ultimate, undeniable financial shield. If you have your life savings sitting in a regional bank right now, earning zero interest while taking on massive systemic risk, you are standing directly on the train tracks. It is time to step off. Transition your excess fiat currency into real physical money before the maturity wall completely breaks the banking sector. If this deep dive opened your eyes to the hidden risks inside the banking system, hit that subscribe button right now. We are building a global community of individuals who refuse to be collateral damage in the next financial crisis. Smash the like button to defeat the algorithm, ring the bell icon, and let me know in the comments below if you have already started moving your capital out of the regional banks and into hard assets. I'm John Agg. Keep your wealth reacting and stay ahead of the curve.